Yesterday, we had the chief equity strategist for Slate Stone Wealth on our show. Erin Gibbs is her name. She's fantastic. She wouldn't be surprised, is what she said, if this oil issue took until 2027 to see the markets normalize. And I thought, boy, my eyes rolled in the back of my head because you know how I feel about talking about oil. I don't like the pressure it's exerting or the influence it's having over all the markets, but it's something we have to deal with. So maybe I think she might be onto something, too, because a little later on after my show, we got this, right? Saudi Aramco, the CEO of that big oil firm out in the Middle East, his name is Amin Nasser. He says that global energy markets have lost about 1 billion barrels of oil supply during the crisis. He also said that the world is now losing about 100 million barrels of oil supply per week as long as the straits are closed. And that's going to be a problem, he says. So if the disruption continues for several more weeks, Saudi Aramco thinks that oil markets may not normalize until 2027. So it sounds like Ms. Gibbs at Slate Stone Wealth has some friends in pretty high places, I would guess. How about this, though? My next guest, he's also got some friends in pretty high places, and we want his take on and see if this is just a short-term spike in oil, or is it something more serious and does it pose a recessionary risk? We're not sure. So please welcome to the show, Mr. Ted Thatcher. Ted, thanks for being on, brother. I want to hear what your thoughts are here. But it's one of those things where one thing can be two things over time. It can be a short-term transitory inflation spike, but if it doesn't go away over time, it becomes a recessionary risk. The same event with two different flavors. What say you?
Yeah, Scott, it's great to be with you. You know, when we think about this oil issue, that phrase higher for longer that's been on repeat in the back of my head now for years talking about interest rates is starting to point almost toward this oil, whole conflict in Iran. We thought, hey, we might be here a couple of weeks. This is going to be really more of a military operation than a war. And look where we are today, 76 days later, WTI is above $100 a barrel. And I think we're starting to ask ourselves, both as investors, as consumers, hey, how long is this going to last? And really, how long is it going to continue to affect the economy for? Because, if we get the Strait to open, and I don't think anybody actually knows when exactly that's going to happen, we'll certainly see that falling knife on the futures prices of barrels of oil. But that doesn't mean we're out of the woods, again, on the investor or consumer level.
I agree. And that you bring up a really good point because I've traded a long time. I'm an old man in this market. This is fake hair. It's not really mine. But you'll see that perception versus reality, right? So you'll see oil prices come off, like you said, quickly, but then they'll probably stabilize a little bit because, yeah, we're going to take the pressure off the whole situation. But that doesn't mean this large U.S. economy kind of right behind that oil price is going to be able to normalize as quickly as a futures price might crash lower, right? So there's that perception versus reality. And the reality is, as much as we'd all like this thing to be over and get back to normal ASAP, the longer it goes on, the longer it's going to take to get back to normal, correct?
Absolutely. We really started, of course, immediately saw the spikes up at the pump, right? When we went to go fill our vehicles up, we would pay a little bit more. About 7 weeks into the conflict, though, we started to see, that higher energy prices leak into the rest of our world. Think about groceries for a second. Now we're starting to see it bleed all the way into the CPI and the PPI and the PCE numbers. But when we go to the grocery store, like everyday Americans, hey, 40% of the prices of the goods there have to do with the price of energy and the price of transportation. And so we have to think about this basically as a big bubble, an energy price bubble that moves slowly through the economy. And so since we're over 2 months into this now, I expect it to take essentially twice as long to move its way all the way out of the economy. And so there really is where consumers get put under pressure. And obviously, if we got the Strait to open soon, that would put us where? Basically toward the end of 2026 or really even Q1 of 2027.
I like that visual you're drawing up there because I've been saying for a long time, it's like a bowling ball going through a boa constrictor, right? So we're just going to have to bide our time as that thing works its way through. And so what do you think ultimately are the risks for this higher for longer oil price? I mean, at what point in time do you start to think, because we've had just tremendous earnings, we've got we're still growing fast, great GDP growth. Where do you think that starts to come into play with this higher for longer if oil does stick around 100 for a much more uncomfortable time?
Yeah, I think it's a really important question. And the way I look at it, actually, of course, is it can't be a problem for equities. If I said that, you'd laugh at me, and rightly so. The problem, the risk it presents for consumers and investors is in prices, and I think the bond market. So obviously, the consumer is under pressure. And Wall Street, I think it's hard to say, has been this divorced from where the consumer is at on Main Street in a while. Obviously, we just hit another record high at 7,500 on the S&P 500 today. But the consumer, we're getting PPI prints at 6 handles. That's the prices businesses are getting. So that's that bowling ball through the boa constrictor that is going to continue to put pressure on the consumer. And, consumers have been under pressure for years now with inflation, and it just doesn't seem to be going away. Again, I think that the governor on this whole conflict continues to be the bond market, specifically the 10-year Treasury sitting at basically not quite at, but close to 4.5.
And I think that's the truth serum. I call it the truth serum. A lot of folks don't know that there's more money in the bond market than the equity markets. And the equity markets, it's kind of the one that goes, it's got its finger in the wind and it goes with sentiment. But really, the bond market is the one I think that tells us the truth. And the truth that it's telling us right now, Ted, I don't like, because we're squeezing higher, close to, right, you're exactly right, 4.5%. And at some point in time, if that thing does go any higher, we need to see it close to 4. And we had just been under 4 until this all kicked off. We need to see it down there for that to give me my last green light to say, okay, this is real. I'll give you the last 10 seconds before we got to go.
Yeah, absolutely. At the end of the day, it comes back to the consumer. And so I think all eyes are pointed, of course, on the U.S.-China summit this week. Hopefully we get some good headlines, and hopefully that straight opens soon.
All right, brother. Great to have you on. Have a great weekend. Redding, California, I know where it's at. Great place to be. Ted Thatcher, thanks for being on.